Sam Khalil from DPN, and welcome to our masterclasses for 2019. We had a great response in 2018 to our masterclasses where we were able to unpack some detailed concepts around property, investing, tax, and what have you. And I've got the privilege again of hosting Ed Chan, who was our presenter at all of our masterclasses last year. So Ed, welcome.
Thank you, Sam. It's really glad to be here.
Yeah, and we appreciate your enthusiasm and your insights. And you know, you've got great experience being in the industry for over 30 years. You've also got a great ability to be able to share complex things and make them understandable and in a simple way. And I think that's the true definition of genius, is taking complex and making it easy. So we really appreciate that. And we got a lot of feedback from previous master classes, and there were some topics that people want to really hear about. We've addressed them, addressed some of those topics, and in this one particular today, we're going to talk about SMSF, or self-managed superannuation funds, and property, being able to invest in property, or somehow utilizing that self-managed super fund to invest in property. And you know, no one better to talk about that than yourself, because you've actually written a book on it, Ed. So, but before we go on, it's really important that we make a disclaimer here and let people know that we're not advising anyone to buy a property through a superannuation fund. The Australian Securities Investment Commission are very, very strict around that. So all we're talking about today is some general concepts and mathematics. We're not suggesting you do that. You really need to, if you are going to consider if a self-managed super fund itself is appropriate for you, or ever buying a property in a super fund, you would need to talk to a licensed financial advisor or financial planner. And so again, today is just a general information session of what might be available for your consideration, but that consideration needs to be done in the context of speaking to a financial planner who will help you understand whether a self-managed super fund is A, suitable, and B, whether you should consider property within that superannuation fund. So it's an important thing, because unfortunately, like anything, there are people out there that take advantage of people who are unaware, set up things, make a lot of money out of the fees of the setup, and put inappropriate products and structures in place. So we want to make sure that you are getting really well informed and making sure it's appropriate for you before we go on. But just on that point, I want to hand over to Ed, who will talk about SMSF property, or property via super fund. So thanks, Ed. I'll hand over to you, and you can begin to unpack that for our audience today.
Yes, thanks, Sam. Thanks for the intro. Just on what you said, yes, it's very important that you get your own, you get advice on your own circumstances, because everybody's circumstances are different, and what we're going to talk about today may not be appropriate for you. It just depends on your own circumstances. So with that said, let's get on with it. Now, a very interesting topic here is self-managed super fund, and it's been around a long time. There's over 600,000 self-managed super funds out there. One of the reasons why it's so popular is because of these two things called control and cost. Lots of people like to have control of their own money, right? And also with some of the investments, like property investments, you can do it through a self-managed super fund, but you can't do it through an industry fund. And that gives a lot of opportunities for self-managed super funds to get into property.
You also mentioned cost there. What do you mean there?
Oh, cost, generally with self-managed super funds, at a particular amount that's in there, it's a lot more cost effective than what an industry fund charges.
Because a lot of people think SMSF could actually be quite expensive, but how can it actually be cheaper than, you know, the normal industry fund or a retail fund?
Correct. So, but it has to be at a certain level. So over 200,000, it starts to break even in terms to what's going to cost you from an industry fund to a self-managed super fund. And if you've got more than 200, if you're in the millions, it's actually cheaper to run your own.
What might that cost be? Because what you know, you mentioned before that there's about 600,000 super funds out there, but the majority, the average balance is $1 million. So it tells you that people who've got a lot of money tend to favour SMSF for a reason. So correct. What would the cost be for a super fund?
Okay, so if you take an industry fund, they charge you anywhere between 1% to 2% of funds under management.
Okay.
So if you're talking about $1 million, you're talking about $10,000
to $20,000.
$20,000.
Okay. Yeah,
that's what they take out.
Yeah.
And to run a self-managed super fund, it might cost you $2,500 to $3,500. So we're talking about more than double the cost.
Okay.
And of course, you don't have any control over it.
Okay.
And with self-managed super funds, if you wanted to,
and that cost is usually some accounting fee and audit fees, and it's like a fixed number, so it's not a percentage of the funds under management.
Correct.
It's just usually an accounting fee.
Correct.
So it doesn't matter how big the portfolio is, up 10 million, it's still going to cost you a couple of $1,000s a year.
Correct. It's just the time that it takes to do the work.
Return,
Yes, as opposed to the funds that are under management, they take a percentage of the funds under management.
Yeah.
So the more you have in there, the more the
Costly.
it gets, or cost
effective in the self-managed super fund environment versus a percentage-based model.
Correct.
And hence why the reason people who have over 200,000, it becomes quite interesting to have a look and see how can I reduce my cost of managing superannuation.
Correct.
Yeah.
Correct. And of course, if it's not a cost issue, but if it's a control issue, then often lots of people do it below 200,000. So, for example, wanting to get into property, that might be a reason to wanting to do that. So, why would you want to get into property in terms of an SMSF? And I'll just explain. It's not so much the property, but it's the ability to leverage what you have in your.
And the structure allows this. Is
correct. The self-managed superannuation fund structure allows you to do this. Whereas you can't do it through an industry fund.
Yeah, of course.
And let's just use an example. I've done some numbers here, Sam, and
let's talk to the numbers.
Yeah, I love numbers, as you know, Sam. Numbers are honest, and there's no emotion
there.
Yes, it tells a story, and you can see on the screen there that, and I'm just going to use an example, and I didn't mean to pick on AMP as such.
They've been picked on a lot lately, yes. Been bashed up a bit at the Royal Commission.
Yes, they have. So let's say you had a couple of $100,000 in a retail fund, like an AMP fund, and it was giving you a return. Now, I've put in 11%, but
generous return.
But it's a very generous return. Although some of the industry funds like Host Plus have achieved 12%.
Yeah.
So they've done well, but AMP hasn't. AMP's been doing 2.5%. So, but let's not pick on AMP. Let's just
let's assume they did really well.
Yes, let's just assume they're doing 11%. So 11% of 200,000 is 22 grand a year. That's what you're making, right? But when you set up a self-managed superannuation fund, you can take that and you can leverage that up, and allows you to increase the size of your asset fairly quickly. So what do I mean by that? So let's go to that second line. So I'll just read this out. If we could add debt at an 80% loan value ratio, LVR, then that allows someone with 200,000 to borrow 800,000, and you can see there 800,000 in brackets. But you take the 800,000 together with your 200,000 that you had originally, and allows you to invest into, in this case, a property.
So this is like a property investment. Your 200,000 becomes like the deposit.
Correct.
And then you can borrow another 800,000, being 80% of the value of the property. Is that right? So it's like something outside of super. Correct. You have some cash, you can buy an investment. Correct. You can do the same thing using super.
Correct. Now, I just want to just point something out at the moment. The loan value ratios for superannuations have changed. They go up and down.
Correct.
Currently, I think they're sitting at about 70%.
That's the average, yeah.
Yes, and at times it might drop. The banks may only lend 60%, but other times it might go to 80%. So I've just done the example at 80%, but please don't take that as
So all that means is your 200,000 might mean you need to buy property. Maybe maximum 700,000 now.
Correct.
You borrow about 500
Correct.
to the 200 you have instead of 800 to the 200.
Correct.
So banks are a bit more conservative, we know that.
Yes.
But it still allows you to have a larger portfolio, not just your 200. Now you can have a $700,000 portfolio.
Correct.
Is that right?
That's correct.
Yeah.
So the bottom line is that you've increased your assets. So if you've got 700,000 or $1 million working for you, you're going to make a lot more money than if you've got 200 grand working for you. And the self-managed super fund allows you to do that. So let's just have a look at some of the numbers. So we've now, in this example, we've now borrowed 800,000 and we've bought a property for $1 million. The interest is going to cost us, I've just used 5%, but you can get interest at, 4%, 4.5%, 5%. So I've just used an average of about 5%. So 5% of 800,000 is $40,000. So we're funding $40,000. So that's money going out. And then your $1 million, let's say property achieved a capital growth of about 7% a year average. Okay, so some years it might give you 15%, other years it'll give you minus 10%. But over a 10-year period, it'll give you an average of about 7%, and that's been shown for quite a long time.
Yeah, a few decades, yeah.
Yes. And so I've taken a 7% capital growth average return, and I've then added to it a rent return of around 4%. So, rents can go from 3% net to 5 or 6% gross.
Okay.
I've taken an average of about 4%. And added two together, you get 11%.
Okay, so $1 million, you're making that 110,000, which is made up of rent and capital growth.
Correct.
Yeah.
So if you take your 40,000 off your 110,000 because that's an outgoing,
Yeah.
then you're making about $70,000 net.
Okay, so that's compared to your 11% just on a $200,000 portfolio. So that's a big difference. That's what's that, $48,000 difference?
Correct.
You
Correct.
get through that ability to leverage or borrow and make
Correct.
money on the bank's money as well.
Correct.
Yeah.
And if I look at the numbers, because your money is 200 grand, it's not the 800 grand. It's your money is 200 grand. So I've made $70,000 on 200 grand, and that gives me a.
So it's 35% return.
Correct.
That's how you got that number.
Correct. So you can see through leverage, through gearing, you can actually improve the return on the money that you've got in there, and that's why property investing through your self-managed super fund has become so popular, because the ability to leverage it and to earn more money out of what's there.
Also, what helps this situation is the fact that a lot of people would have money going into super every year through their annual contributions, whether that's their employer or they do things like salary sacrifice. So
correct.
It's quite an effective way to service this loan,
yes,
where it won't cost you any extra, or potentially cost you nothing extra, because the money that's going in super from your employer contribution, along with the rent you're collecting, can often cover the interest and expenses.
Absolutely. And of course, if you wanted to get it closer to a positive gearing, you just reduce the LVR, reduce your
put a larger deposit.
Put a larger deposit and borrow less money, and reduce the size of the asset that you're going to buy, and that makes it positively geared, so it reduces your risk as well.
Yeah. So maybe talk a little bit here while we're on the detail of salary sacrificing and how that can be an advantage, because particularly some people who might be getting along in their career, they've probably paid down a lot of their mortgage, and they're looking for some tax-effective way of investing. If they've bought a property in super and they salary sacrifice, what are some of the tax benefits there, and why would they consider that?
Yeah, sure. The very first obvious one is that the tax on contributions is only at 15%, not at.
Depending on the highest tax rate, could be 45.
Correct.
Plus Medicare or something.
Correct.
47%.
Yeah. So if your tax rate's 47%, salary sacrificing the super, you drop it down to 15%. So that's quite a bit of savings.
So that's salary sacrifice. The way I explain to people, it's like on that last bit of income, you tell your employer, don't give it to me, put it in my super fund.
Correct.
And if they put that into their super fund, let's say it's $10,000 a year extra that they don't take as income in their pay packet, they only get taxed at 15%. So $8,500 goes in the super fund of that $10,000.
Correct.
Versus if they take in their pay packet, $4,700 goes in tax.
Correct.
Then that was $5,300. So you've instantly got about a 27% return.
Absolutely. Correct.
Yeah.
So that's the attraction of it. Of course, over the years, so
it's like legal money laundering, isn't it?
Yes, I suppose you could put it that way. But they have reduced the.
So there's a cap on how much you can do with that, right? Yeah.
So
how much
they've been reducing it down and down. So the Labor government's come up with a further reduction.
Okay.
So you can only put in. So you can put in. Deductible contribution, which you can claim as a deduction, or non-deductible, which is non-concessional. That's about 100,000.
Yeah.
So
but for your salary sacrifice, what's the most about? It's about 25,000. Okay. So you got to think of what your employees put in. So if you're on about 150,000, you got to work on the fact that your employees put in close to 15,000 of that 25.
Correct.
So the most that you can get as another amount you can salary sacrifice would be about another 10,000.
Yes, up to the 25.
That 25 limit. Yeah.
And it depends on your age and so forth.
Yeah, of course.
There's different levels.
Yeah.
But in the main, it's around 25.
Yeah. But coupling the fact that you could use your superannuation funds that you've gotten, again, in this context, SMSF could be money you combine with, a partner.
Yes.
It's not just your own super.
Yes.
So together you can combine your supers, put them together.
Correct.
And up to 4 people at the moment, but I believe that's changing yet. Is that right?
Yes, there's proposed changes to increase it to six people. So, yep, 4 people could get together, roll their...
Potentially up to 6 people, put all their super together and buy a sensible sized property.
Correct.
And then the ongoing contributions. Now, but how does that work then to know who owns what? Because, so I guess this is where this audit comes in, or this accounting every year.
Yes.
Like a normal retail fund?
Yes, the balance sheet's kept, so it identifies whose money belongs to whom in your balance sheet, and the accountant prepares that, and it gets audited by an auditor.
Yeah.
And so it's an annual situation.
Yeah, so everyone's got their fair share depending on how much they put in super, how much goes in every year.
Correct.
Of what their percentage of that fund is.
Correct. And as the asset, in this case of property, increases in value, then your proportionate capital that's sitting in there also increases based on the amount of properties increasing by.
Excellent. Right. Thanks for that. That again illustrates that some people may not be aware, but they might be thinking, how can I get an investment property? Whilst they might be maxed out on their current mortgage or limited in that, they don't realise now that superannuation's been law for a number of years in Australia.
Yes.
And the average amount in super is quite considerable. Yes. And when you have 2 people maybe together, they combine that, it's not too hard for too many people these days to get that $200,000 threshold, where it makes it something they can consider looking at potentially approaching a financial advisor and seeing if they can do a property in super.
Correct.
Then they can take that advantage of leveraging and turbocharge their portfolio in a sense to have a larger portfolio.
Correct.
And get a greater return.
Correct.
That's excellent. Yeah. Fantastic. So, look, I appreciate you unpacking that there, and there's obviously a lot of complexity and detail around that, and I think that's really important. And just maybe Ed, you can tell us a little bit about Chan and Naylor and the fact that you guys have been in business for 30 years, and how someone, along with your experience, tell us a little bit more about that and what your company does. But how, if someone was interested in self-managed super, how may they start that journey?
Sure. We're an accounting firm, Sam. We've got 13 offices around Australia. There's about 160 people in the group. And we do tax returns. We set up self-managed super funds. We're also a financial planning organisation in finance.
So you can do everything for someone if they're interested. So you're not just an accounting firm?
Correct. Yeah. So they could come along if they wanted to set up a self-managed super fund. We've got the financial planner there that will do that for you. And then we can do the audits and the tax for you for that as well.
So it's a one-stop shop in relation to that.
Basically one-stop shop. Yeah, we don't find the property for you. You'd have to find the property.
That's probably where we come in, but we can talk about that in a second.
Right. So yeah, any of the offices around Australia, there's that service for clients, and been going for quite a while now. And we're known for property, Sam.
Yeah.
In fact, we developed a thing called the Property Investor Trust, which has got
otherwise known as PIT.
PIT, yes. We went to the ATO and got a product ruling for it. And what it is that it's specifically designed for property. And unfortunately, with all the other types of trust out there, they weren't specifically built for property or designed for property. So they've all got some downsides or negatives to it. But we built the Property Investors Trust from ground up to suit property. And
it's brilliant.
To give you an example, it doesn't have a vesting date, and a vesting date is when the trust runs out after 80 years, and most of the other trust deeds have an 80-year vesting date. Well, we found a way around it and trademarked it so that that we protected that intellectual property. But the ATO granted us a product ruling, which is the first time in Australian history the ATO has granted a product ruling for a trustee, so that was quite historic.
So the great thing about that is that if you hold property for a number of generations, it may not be a concern to you now, and you think 80 years you'd be long gone, you and I, but you really got to think of your kids or your grandkids.
Yes.
That if you've bought a property in a really good area, you want to give them that option. They don't have to sell it. Whereas with a normal trust, that would vest, and they would have to sell that and trigger massive amounts of taxes at that time, which is something they may not. So you basically could hold it for eternity, as long as mankind exists, with that particular trust.
Absolutely.
Yeah.
Absolutely.
That's a great product. So, and look, again, you can see here that Ed has written a number of books around business, how to turn a small business into a great business, how to legally reduce tax, and also addressing wealth for life. But also, if you're particularly interested in understanding a bit more about a property in SMSF, Ed you can get Ed's book on that. And as Ed mentioned, their firm is really there to help with the structural tax advice, the financial planning around setting up self-managed super or anything to do with normal tax accounting and investment properties, but the actual research or assistance in finding that property is where our firm comes in. And as DPN, we're a successful property firm. Our background, actually, our roots are in financial planning, but we shifted from that and decided to become really competent and skilled around property investment and finance. So what we do is we partner with accounting firms, with finance brokers, with accountants and what have you, just to really provide that property solution. Because a lot of people, when it comes to investment property, don't have a strategic approach. We've won a number of awards in our industry and beyond around innovation and in the product design and selection. We create wonderful products that are, some of them are cash flow positive. They generate 2 rents off the one property. But one of the things that we do provide is a customized portfolio or a complimentary portfolio review. It's usually about $495. But for people listening to this masterclass, if you register at hello@dpn and say you've responded to this masterclass, we'll provide you with that complimentary session. That's where we customize a strategy for you, for where you're at, because everyone's situation is different. And we need to look at where your current assets and resources are, where your income is. We can help with the finance. A lot of banks have actually withdrawn from self-managed super fund lending. As an organisation, we've actually got approval to do that now ourselves. We've got a mortgage management business, so we can do that at much cheaper rates than what the banks have been doing. And we can actually approve loans internally for self-managed super funds. So our objective is to, again, help with the research and the sourcing and the strategy around property, and we can help you look at that for normal property investments and your home loan and investment property loans. We can do the loans for self-managed super funds, but we then work with firms like Chan Naylor that if you want to consider a property in super, they can provide the compliance, the legal framework for that from a financial planning and accounting point of view, but we provide the actual property that can fit within that to help you achieve that financial independence. So thanks once again for listening today. If you're interested, just send us an email at hello@dpn.com.au. Check out our website, or even connect with Chan Naylor as well. Their details are info@channaylor.com.au. So we thank you again for listening. Ed, thanks again for your, again, simple to understand but expert insights. Really appreciate that.
Thanks for having me, Sam. See you next time.
Thanks for listening, everyone. Appreciate it. Cheers. Down.
Good.
Well done.
Well done.